Brad Williams, Frugal Finance Investing. Talk a lot about stock splits. Well, let's talk a little more about reverse stock split. What is a reverse stock split? When a company completes a reverse stock split, each outstanding share of the company is converted into a fraction of a share. For example, if a company declares a 1-for-10 reverse stock split, every 10 shares that you own will be converted into a single share. If you own 10,000 shares of the company before the reverse stock split, you will own a total of 1,000 shares after the reverse stock split. The company may declare a reverse stock split in an effort to increase the trading price of its shares. For example, when it believes the trading price is too low to attract investors to purchase shares, or in an attempt to regain compliance with minimum bid price requirements of an exchange on which its shares trade. In some reverse stock splits, small shareholders are cashed out, receiving a proportionate amount of cash in lieu of partial shares so that they no longer own the company's shares. Investors may lose money as a result of fluctuations in trading prices following reverse stock splits. Although the SEC has authority over a broad range of corporate activity, state corporate law and a company's articles of incorporation and bylaws generally govern the company's ability to declare a reverse stock split and whether the shareholder approval is required. If a company is required to file reports with the SEC, it may notify its shareholders of a reverse stock split on Form 8K, 10Q, or 10K. Depending on the particular facts, companies pursuing a reverse stock split may also be required to file a proxy statement on Schedule 14A if shareholder approval is required, or a Schedule 13E3 if the reverse stock split will result in the company going private. Reverse stock splits are bad. It's usually an indication of a company just barely hanging on, and they'll play these games. For some reason, they do a reverse stock split, then they somehow recover. You can see them reversing this and issuing stock, doing a normal stock split. It's the case with GE. They did a reverse split, and it looks like perhaps the parent company may, at some point in time, from that reverse stock split, just switch it around to a normal stock split if the performance of the company improves. Interesting how this works. The games of Wall Street, don't be surprised if you're caught up in a reverse stock split because you didn't monitor your portfolio and there were a couple losers and Wall Street goes and plays this game of doing a reverse stock split. Well, it's usually a bad indicator and maybe it's time to sell that, take the loss, and offset it against your gains. Comment. Let me know if you've been caught in this bad situation. I have. I lost a ton of money, but it was a risk worth taking, and subsequently it was a lesson learned. But anyway, I don't want to go off on any crazy tangents. Comment if you have any questions as it relates to reverse stock splits. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.